If your plan offers the CARES loan provision, there's a lot of questions on what the provision is and how it works. So Allison, can you start walking us through the CARES loan provision and how that works?
Sure. So a CARES loan offers a little bit broader borrowing ability than a typical retirement plan loan. So in a CARES loan, those impacted by the coronavirus can take a loan for up to 100% of their account balance or up to $100,000. There's some additional flexibility in the CARES Act to delay loan repayments. So repayments otherwise due in 2020 can be delayed for up to a year. That means someone taking one of these CARES loans can take that loan now and then not start repayments until 2021.
And who's eligible for a CARES loan?
Mhm. So the CARES Act outlines those impacted by the virus. That would include anyone who's been diagnosed with the virus, who has a spouse or dependent who's been diagnosed, or who's experiencing a financial impact due to the virus. And the Act outlines reduced hours, layoff, furlough, even being out of work due to lack of childcare, or having a quarantine situation, all as potential financial impacts of the virus. And any of those situations would allow someone to potentially qualify for a CARES loan.
And is that a self-certification?
It is. The Act allows self-certification. So that means you don't have to provide documentation or proof at the time that you're taking out the loan. Keep in mind, though, there is potential for audit in the future. The IRS could come back and review that in the future. And if you didn't actually meet that definition of impacted, there could be potential for penalties.
So once I take the loan, what happens to my repayment process? How do I make
Mhm.
repayments?
Sure. So the repayments under a CARES loan would follow a typical loan repayment process. In most plans, that's through payroll, so automatic payroll deductions. Some plans do offer repayments directly from bank accounts. So check with your plan administrator to confirm your process. And those repayments would most likely start in 2021 under the provisions of the CARES Act and then would continue until the loan is paid off.
And what if I don't fully repay the loan? What happens then?
So, in the event that you stop making payments, your loan will become delinquent, and after a period of time, it'll go into default. And at the time of default, the outstanding of the balance of the loan will become taxable to you in that year at your tax rates in the year of the default. And you'll also face the early withdrawal penalty if you're under 59 and a half. So that's an additional 10% tax if that loan does fully go into default.
What if I already have a loan outstanding? How does that impact my ability to get a CARES loan?
That very much will depend on your plan and your plan's provisions. So check with your plan administrator about your ability to take a loan under the CARES Act, particularly if you already have a loan outstanding.
In terms of taking a loan, how does that impact my overall retirement savings?
Sure. So much of that depends on if the loan is repaid. Certainly, if you don't fully repay that loan and have that default situation and you're not repaying that money, that's going to reduce your accumulated retirement savings permanently. If you do repay your loan, you're repaying that with interest. So you've got a little bit of earnings on top of restoring the money that you've borrowed from the plan. But you are missing out on earnings given that that money is out of the market. And then, of course, you're missing earnings on the missed earnings. So overall, those who take loans do accumulate less in retirement savings versus those who don't take loans. We certainly recognize in the current economic environment, lots of folks are dealing with an economic event or a financial impact, and the 401k plan and your account balance may potentially be a reasonable source of funding in order to meet that need. We certainly suggest considering all of your options, though, prior to taking a loan.